So, a full-blown trade war between the US and China. It's one of the biggest what-ifs for 2025. But what would it actually look like? Not just in headlines, but in the cold, hard numbers. Well, let's break down what the economic models are telling us.
Let's just cut right to the chase. Two of the most respected global economic models out there, GTAP-FIN and Mirage Power, ran the simulations on the proposed tariffs. And the picture they paint is pretty rough. The United States could see its real GDP shrink by anywhere from 1.3 to almost 1.9%. And as you can see, China is also looking at a significant hit. No matter which model you look at, the conclusion is the same. This is basically a lose-lose situation for the main players involved.
Okay, so seeing those numbers, you've got to ask two really big questions, and that's what we're going to unpack here. First, how on earth did the tariffs get so high? And second, what else do these incredibly complex models predict is going to happen to the rest of the world economy once the dust settles?
To really get your head around those high rates, the first thing you have to realize is we're not talking about one single tax. What we're actually looking at is a tangled web of different duties, all layered on top of each other.
The key idea here is something called stacking. And honestly, the best way to think about it is like you're building with blocks. Each new tariff is another block you put on the pile, making the wall higher and higher, and making it that much harder for goods to get over.
And you won't believe how quickly it all adds up. So you start with the 25% Section 301 tariffs that were already on the books, okay? Then you stack on a 20% fentanyl tariff. And on top of that, you add another 10% reciprocal tariff. And boom, all of a sudden, the duty on a single product isn't 25% anymore. It's over 55%.
And things got really wild in the spring of 2025. I mean, this was not some slow, gradual process. We're talking about a single week in April where that reciprocal tariff just exploded, going from 34% to a mind-boggling 125% after China hit back. It eventually came down after a truce, but that kind of chaos, it creates massive uncertainty for any business just trying to plan for the future.
So when you throw a wrench this big into the global economy, how does it react? Well, to figure that out, economists run simulations. And it turns out everything hinges on one absolutely critical word: retaliation. To really get this, the models look at two totally different worlds. Okay, so imagine a fantasy world where the US puts on tariffs and nobody does anything back. In that scenario, the US actually sees its terms of trade improve, which is just a fancy way of saying the stuff you sell is worth more compared to the stuff you buy. But let's get back to reality. The moment other countries retaliate with their own tariffs, that whole advantage gets wiped out. Suddenly, US exports are too expensive, demand for them dries up, their prices fall, and your terms of trade get worse. The bottom line, the money in your pocket buys less, not more.
And of course, in the real world, you have to assume retaliation is going to happen. And under that assumption, both models show a clear drop in GDP for the US, a drop for China, and, as the Mirage model shows, the entire world economy takes a 0.5% hit.
But here's where the story gets really interesting. A global trade war isn't like a rising tide that lowers all boats equally. Oh no. When there's this much chaos and disruption, some countries can actually come out ahead.
And it all happens because of this thing called trade diversion. Think about it. If you're a US company and it's suddenly crazy expensive to buy from China, you don't just stop buying things. You start looking around for a new place to get your stuff. You divert your trade.
So who's on the receiving end of all that diverted business? Get this. The Mirage model projects Mexico's economy could get a massive 6.6% boost. Canada also does pretty well with a 1.3% gain. I mean, it makes sense, right? They're right next door, they're part of the same trade agreement, they are perfectly positioned to scoop up the business that China loses. And this pattern of winners and losers doesn't just happen between countries, it happens inside them too. A trade war can pick one industry to be a winner and another to be a loser, right in the same economy. And you can see that split pretty clearly right here in the US. On one side, you have industries like textiles, which are suddenly protected from Chinese competition. They could see huge growth, a projected 23% gain. But on the flip side, sectors that depend heavily on exports, like our farmers selling oilseeds, get absolutely hammered by those retaliatory tariffs, facing a painful 14% drop. So, some jobs are created, some are lost, but what about wages overall for American workers? Well, the researchers behind the study point out something really important. They say the models predict, and I'm quoting here, a negative impact on wages for both skilled and unskilled labor. And that's a tough pill to swallow if the stated goal is a worker-centered trade policy. All right, let's pull all this together and tackle one last really big claim that's been made about this whole strategy.
So to recap, we've got these stocked tariffs leading to super high rates. The big economic models agree they're bad news for both the US and China, especially with retaliation. And we've seen how this mess creates surprising winners, like Mexico, while creating a painful divide between different industries right here at home.
But there's that other argument, right? The one about all the money these tariffs could bring in. There's been talk that they could raise so much revenue, they might even be able to replace the entire federal income tax. So, could they?
Well, the economists who ran the numbers have a pretty clear answer for that one, and it's a big fat no.
See, the Mirage Power model actually did the math to find the perfect tariff rate to make the most money possible. And that rate, a whopping 80%. But here's the kicker. Even with that massive tariff, the most revenue it could possibly generate is about $819 billion. Now, compare that to the income tax, which brought in almost $2.2 trillion in 2023. You're left with a shortfall of, well, over $1.3 trillion. It's not even in the same ballpark. Ultimately, when you look at all this, you realize these models are doing more than just crunching numbers. They're showing us a picture of our global system under incredible strain, with really complex and often painful results for a lot of people. And when you see the potential outcomes laid out this clearly, it makes you step back and ask a much bigger question. What does all this mean for the very future of global trade as we know it?